What's going on, guys? Hope you're having an absolutely fantastic day. In this video, we're going to be talking about two stocks, namely Amazon.com and also Elf Beauty Incorporated, right? So let's start with Amazon. You can see Amazon is down about 4% after hours. And what's the reason, right? So first of all, it's weak guidance, right? If you take a look at the guidance, it was, I think, 5 to 9%. Yeah. Look, grow 5 to 9% compared to the first quarter of 2024. So that's a very, very weak guidance, right? Because generally, I think people expect Amazon to perform at a 12 to 15% revenue growth rate. And if you take a look at this, the second, I think, very big thing is also the capex rate. 105 billion in capex in 1 year, right? So these AI hyperscalers are actually very, very insane, right? And you can see that Amazon is a cash printing machine, right? Because who has 105 billion to spend to just AI and capex stuff like that, right? So take a look at Amazon's revenue. You can see that over the years since 2020, right, it's actually been decelerating, right? You can see that 2020 and 2021, they had really, really good revenue growth rates, but now it's in the single digits, right? And then next year they say 5 to 9%. So if you take the midpoint, it's a single digit rates. So you can see that maybe the scale of Amazon, like how big they have gotten, has limited the amount of growth that they can have, right? So I'm not focusing too much on these big companies, like the Mac 7 or what, right? So I just want to describe explain my thinking regarding this, right? So there are so many analysts that are covering all these companies, and I take a look at it because obviously it matters to the general market, right? But in general, you won't find that many opportunities looking at big stocks like this, right? Because their market caps are in the trillions, and I think what we're working with are only thousands of dollars, right? So you're not a hedge fund or something that has like 10 billion under assets under management, and if that's the case, I think you would find it hard pressed to find a very good opportunity like that, because the reason that hedge funds don't look at smaller stocks like Elf Beauty that I'm getting into is look at the market cap. $5 billion market cap. After the open tomorrow, it's going to be like a 3 point something billion dollar market cap. If you have a 300 million, you'll buy 10% of the company and you'll probably move the price. So that's why these big fishes don't swim in these kind of ponds, right? And I think that is why we should swim in these ponds, because if they are not looking at things like this, means that there is a higher chance that we can find an opportunity somewhere here, right? Because if you have hundreds of thousands of dollars to deploy, I think these are more suitable places for you to look, right? In fact, I would go even smaller to like tens of millions of dollars market cap for people who have a few $1,000s. But I think it depends on your conviction and also your confidence, right? Because for me, I wouldn't be very happy to invest in a illiquid asset which has maybe like $75 million market cap, unless I'm very, very sure that even if tomorrow it goes down 50%, I'll still be buying more, right? Because I know the intrinsic value that well. But let's get on to Elf, right? So you can see that Elf actually, they are growing revenue 31% year over year, but again, weak guidance, right? So a theme that I've been seeing from a lot of companies that have been reporting earnings, and sorry that I don't do that many earnings, right? Because I cannot follow that many companies that well and understand them that well. So you can see that EPS actually missed. Maybe that's part of the reason the stock is down. But I think the big part of why the stock is down is something like this, right? You can see that it's about 10% below analyst estimates, right? You can see that looking ahead, revenue is going to grow by 14.6%, right? From the 30% that it was growing at this year. So that's why probably why the stock is down so much, right? Because you go from people expect you to grow for 30% to eternity, right? Which obviously that cannot be the case. That's why you can see a lot of stocks like Celsius and Elf in this case have been absolutely destroyed, right? In the past, I think 1-2 years, because people expect them to keep growing to the sky. And you can see that instead of 30%, they're going to come in with 14.6%, right? So this is clearly showing a weakening in the market, right? When you take a look at Amazon's results, also is telling you in some sense, right, the general economy is weakening. Maybe also looking forward, because most of their products come from China, people basically expect the US to slap massive tariffs on China, and I think that might be part of the reason also, right? So I want to go back to a simple way to do this. Let's say full year. I think there's a full year earnings here, right? 3.3, I think. Yeah. 3.3, the full year earnings. So obviously, I wouldn't exactly use this, but for simplicity's sake, I think I'm just gonna use this to show you guys how roughly to do the valuation. But let's say 3.3 and you expect the earnings growth for 5 years, right? So for something like ELF, I think I would expect it to grow about 15% for the next 5 years. So let's say 1, 2, 3, 4, 5. And generally how I estimate the earnings growth is actually what their revenue growth is going to be, right? Because you can't grow revenue, you can't grow earnings much more than revenue, right? Even though some companies have, such as Apple, by buying back stock and things like that. But I think in general, it's a good way to estimate, right? Because let's say you estimate at 15% and they grow revenue 15% for the next 5 years and they buy back shares and things like that. That's all gravy on top, right? You don't want that to build into your base case, right? So let's say if it's 15%, and I will come up with more detailed models when I do deep dives for this company specifically, right? But they do 15% for 5 years, and then I times it. I think by that time, maybe it's a more mature company. But 15% earnings, they should command at least a 22.5 PE, right? So this is like $150, and currently it's trading at what? $66.5. So this is let me just divide this first. So this is about 2.25x over the next 5 years, right? So whether that's good enough for you, that's another question. I generally target maybe a double or a triple within 5 years. Obviously, that's a big delta, right? But I have some shares that I will do deep dives on soon that I think might double or triple in the next few years, right? So the reason that this is a base case is fine, right? Because like, let's say if you can double your money in about 5 years, that's about 15% return. I think you'll be okay with that, right? If that's the base case. What if something better happens? What if those tariffs don't come in as heavy as expected? And basically you can have more upside, right? But don't build everything into the upside, right? I try to use a pessimistic case, right? Because you see 15% revenue growth is considered slow growth for ELF, right? So you can see that their revenues have been growing much faster than that, right? So let's see here. And then you see these few years they have been growing much faster than that, right? So we're just expecting a reversion to the mean, and going back to 2022. So do I think they can grow faster? Yes, absolutely, right? If not, I wouldn't be interested in looking at this, right? Because double in 5 years, it is very good. But if there's no additional upside, because downside is always there, right? You have your base case, you have your bull case, and you have your bear case, right? So downside is always there, but I think at these current prices, especially after tomorrow's drop, if the prices hold, right, I think it's looking like an attractive opportunity. Obviously, I'd like to dive deeper because I don't really dive that deep until something like this happens, right? And it's down 25%. Then I'm like, maybe something's interesting here. So I'm not exactly like 100% confidence with this, and in fact I'm never 100% confident, right? But you can get to a very high degree of certainty, like I do have with maybe Chinese stocks. So I'm going to have like Alibaba and JD.com stock breakdowns in the future. So if you're gonna enjoy that, do smash up the like button and hit subscribe, right? But I think those I have more confidence because like let's say for Alibaba and JD.com, Alibaba, if you strip out the cash, is about 7 times earnings. But I'm going off a tangent here. But basically, I'm talking about like confidence. And so yeah, in my opinion, ELF Beauty starting to look like a very interesting opportunity. Whether it can fall further, that's not our concern, right? Our concern is whether currently it looks like a good opportunity. And if it does, and if we think it has a defendable moat and it's growing its market share, I think it's prudent for us to take a deeper dive and look for the opportunity, right? So you compare something like this with Amazon, and there's just too many eyeballs on Amazon, right? So even when they are guiding for such low numbers, their stock is down 4%. That is not even more than basically the negative impact that the slow revenue growth has, right? So yeah, I think these are like the main points that I wanted to share today, right? Basically Amazon news, just to catch up with the general market, and then how to look for opportunity, right? You want to look in the smaller ponds, right? Because currently our constraint is capital, right? You don't have billions under management, so you don't have the problem of, oh, if I look at Elf stock and I want to put $300 million to work, I won't be able to do it because I need to buy up 10% of the float, right? So, and obviously when you have 10% of the float, there are regulatory things that you need to get into, things like that, right? So I think this is also a lesson as to where to look for the opportunities, right? Don't always think that, oh, everyone's looking at Tesla, Google, Meta, all these big companies. Sometimes there are opportunities that, such as Meta in 2022 and also Amazon in 2022, right? But obviously, if you had to pick between those two, you would pick Meta, right? Because it's what 7x since the bottom, right? So yeah, that's all I wanted to share today. With that being said, have a fantastic day ahead and peace out.